Good Monday morning, Market Chameleons and everyone joining us for the first time. Thanks for checking out the Market Chameleon pre-market show. Thumbs up are always appreciated for this man, Dimitri Pargamonic. How you doing, D?
Sorry. Hey, Will, how's it going?
Hey, good. You want to start with a disclaimer? It's up there for everyone to see.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And with that, let me share my screen. I think what we'll do today, Will, is, well, if you guys are joining us for the first time and you have any questions, you could put those in the live chat on YouTube. Will's monitoring them. He'll read it back to me. If you want to come on a show and ask your question live, we also put out a link to Zoom. If you click on that link, it takes you over to Zoom. Once you get over to Zoom, click on raise your hand. You don't have to turn on your video camera, but you'll be able to ask your question directly. It could be, Market Chameleon tools, data, strategies, analytics, something that maybe you've seen that is unusual. You want to bring it up, or you want to share something that you've been doing that's been working out. That's also helpful. So those are two ways to ask questions. In the meantime, while we're waiting for any questions to queue up, what I'll do is start looking at the pre-market report, take a look at what's moving in the pre-market hours. We'll go over a report to see some of the earnings that are coming up this week. I think we've got some big tech companies coming out. And we'll just take a look at, maybe the breakdown in S&P 500, see which sectors are doing, which are still doing relatively well, which ones are performing poorly. Sound good, Will?
Perfect.
All right, so this is the pre-market report, and these are stocks that are trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Right now, I see 40 stocks made our percentage gainers list, 255 stocks on a percentage decliners list. So from that perspective, we're looking at a pretty bearish bias at the open. Let's filter out this list to see what's going on in the S&P 500 stocks. So this way, we're going to filter out small cap stocks, ETFs, leveraged ETFs. We're going to take those out just to get a sense of what's going on in the S&P 500. To do that, I'm going to use the filters above. And this filter in ETF, if I drop it down, I could select one of these ETFs. The top one, SPY, is the S&P 500 ETF. By choosing that, this will filter out SPY holdings, which are the S&P 500 constituents. And we see here, 4 made the percentage gainers list, 47 on the decliners list. So right now, we look like, we're setting up for a bearish bias at the open. Top of the list right now on the gainers is Twitter, up 4.8%. And I think that's because it looks like we're much closer now. Elon's going to make a deal to take that company private. And I think probably what's helping him right now is that the market is just dropping, right? And these investors are probably looking at it. They're like, do we really want to fight this? Because if this doesn't go through, what do you think? Well, where's Twitter? $30? Yeah.
Back below 35, that's for sure.
That's the problem right now for shareholders. When you're in it, when the market's turned down, and even these big investors right now, right, what they're looking at their other holdings falling, and they're not gonna, and I don't think they're gonna put up much of a battle anymore. So that is, I think, working in his favor, because these shareholders probably, I'm imagining the way the market is going, are probably seeing their other holdings dropping, and that's going to make you lose confidence. And really, even if Elon, if he probably waited or walked away, you'd think you'd get the company even cheaper at this point, don't you think?
I think so. I think so.
Just judging the way Facebook and everything else is moving, you know, he's definitely looks like right now that he's paying a pretty big premium for Twitter. You know, if you look at, so let me just take a look at this Twitter before we move on. You know, so it's Twitter right now, like a 40 billion market cap, price to sales. So you're paying 7.4 times its revenue, right? And just comparing that, what's the closest? Facebook. You can see Facebook's been falling. I think that's a 52-week low. So Facebook's at a 52-week low, 4.6 times revenue, and still going down. So right now, looks to me like that's a pretty high premium, very hard for shareholders probably to walk away from. And it'll probably be very hard for that board to justify, right? Not making the deal at this point. But, you know, things that I think that Elon will have to also think about, because he's saying, and I'm sure he has a vision for it, you know, to make this company probably much more competitive with Facebook. But you do have issues now, you know, with regulations coming on, you know, including, you know, we've been talking about it, you know, privacy laws, tracking devices, you know, information. And some of these will, you know, if you look at Facebook, Twitter, you know, the people who are, it's not just about free speech, you know, but I think the debate going forward is privacy, right? Like, you know, how much of this personal information and tracking what are they doing with that information? How are they monetizing? Because these public forums, they have to monetize that information. And I think that, you know, tracking and things you say on there are becoming liabilities, you know, for people as well, because you're hearing, you know, people, you know, you could be a college student, you know, get drunk, do something stupid, you know, somebody videotapes you, puts it out there, and that might cost you a job.
You don't even have to be a college student, dude. You could be someone in elementary school, middle school, high school.
Yeah,
it's one of the big things you have to talk to your children about once they get the phone. Is anything they do on that phone and share is recorded in human history now, right?
Yeah, you're seeing them, like, you know, pop. You know, you hear about, you know, things being used against people, you know, in lawsuits, divorces, job applications. You know, like people, you do things without thinking about it. You know, you post things doing silly things, and then it could come back, you know, and be used against you. So there's a lot of stuff going on here, and, you know, that he's going to have to deal with. That I think in the beginning there's a lot of growth. You know, people were using it, but now there are negative impacts to these. We heard about even you know, the whistleblowers from Facebook. So he'll have to deal with a lot of that as well, and that's coming down the pipeline. That's still yet, you know, being debated, and those rules, regulations are going to be coming down the line. Having said that, let's go to, let me take a look real quick. I'm going to take a look at the snapshot of the S&P 500. These are the S&P 500 ETF sectors, right? So we got S&P 500 here. You know, we see here so far, it's kind of been, you know, we've been dropping here. And over here, these ETFs represent the different breakdown in the sectors, you know, consumers, communication services, consumer discretionary, energy. And just looking at the 1 year basis, on a 1 year basis, S&P, you know, as of today, still up 3.3%, not year to date, but 1 year basis. Communication services looks like that is the worst performer, down almost 19%. Best performer here, that's really, I think, holding up a lot of the S&P 500 is the energy, 61.8%. Right. So that came roaring back. At one point, it was just continuously going down. Now it came rolling back. So that's a big sector holding it up. Then you got the real estate. And this one is probably, to me, right now, the most surprising how well it's holding up. And that might get hit, in my opinion, next, because that's very interest rate sensitive, don't you think? That real estate sector, it's basically, priced off interest rates, right? It's you're
Yeah, certainly for an
how much can you
individual
yield?
buying a home, it's very
Yeah,
interest rate sensitive. You just got to wonder. I saw BlackRock bought a REIT,
yeah,
one of those college community REITs. I think it may have been the biggest player. So the private equity firms
are pouring money into it.
are in a lot of these markets, right? Which is shocking to me, but they've been able to buy single family homes and put a management style together that allows you to manage the homes, buy the homes in residential communities, right? And that
Right.
also has added to the support of individual home
Yeah,
prices, because a lot of individuals are being priced out of the market, which
yeah,
works
it's
into the
very,
investors' hands because they now have to pay rent, which is going up significantly in a lot of places.
yeah, and that's going to be something that I think the Fed is targeting, right? That's something they're looking at, because that goes into their inflation calculation. What are the affordability of housing, and they calculate, rent. I think they even put more weight towards rent than they do on prices. But if we're seeing rent inflation, housing inflation, the Fed, the government, they're going to target that. It's an important sector. They can't let it run away. They don't want to bubble. So that one, to me, it's been holding up really well. But right now, what we're hearing is that we might be at 3.5% on the Fed funds by the end of the year. That's possible, right? We've heard some Fed speakers saying that. So if we're going to 0 to 3.5% right now, the long bond, the 30 is 5%. Whereas the 5-year will at the end of the 30-year mortgage at the end of the year for at 3.5%. It's going to be,
What are we, 6.5, 7? Where's it going to be?
right. So that's going to be, I think that could be an issue for this sector, potentially, the REITs. And it's all about, right, the spread, the yield, right? You're competing against bonds and so forth. So let's take a look. If there are no questions coming up, I'll take a look at what's coming up in the earnings front.
Perfect. And if
All
you
right.
look at that, if you look at the housing stocks themselves, like Vanian, Toll Brothers, they're near 50. They've already been,
Yeah.
they're
in
a bear market.
Let's just take a look. Yeah. So this is the REITs. Let me see. Here are the holdings. All right. So these are the holdings in the XLRE. And we could see here on a 1-year basis. Right. I'll just look on a 1-year basis. I'm sorting these. There's only one VNO, one REIT is down. And you could see some of them are up, over 40%. The top 5 are up over 40%. I'm going down 33, 32. So, they had quite a run here, very high levels. So you're going to compete REITs, right? You're buying them for dividend yield. And if you're buying them for dividend yield and that risk-free rate continues to go up, I think they're going to be under pressure. So one thing I think we'll keep an eye out, see what happens here, but that's been holding up, pretty well so far, I would say, given the circumstances. Earnings. Let's take a look what's coming up on the
Hey, D,
earnings front.
real quick,
Yeah.
I missed it. I apologize about that, Rob. There is a little bit of a delay. I'm assuming the page, he wants to know how you got to the page you were on. I'm assuming it's the page you're on.
This page here.
I think it
on
was
the
the XLRE. It was when you were on the real estate.
Oh, okay,
real
so
estate
I
sector.
started up. Yeah, I looked up. I was on the snapshot over here, snapshot, and here I was just looking. These are the implied volatilities. Down here are the stock performances of the SPY and all the in the breakdown of the sectors. So I just clicked on XLRE, or you could type it up here. XLRE, which is the real estate sector, and it takes you to this page, right? To the XLRE page on the summary page. And I went down here, ETF info. So these are only for ETFs, and I selected holdings. And that allows me to look at the components that make up this ETF. So I could see the different stocks, right? And their weightings in the ETF, their market cap, their performance. So I could kind of just really quickly scan with my eyes what's going on here. But that's how I got to this page.
And then how'd you get, I guess, to the holdings, right? All right, there you go.
So yeah, under
Perfect.
ETFs,
Yeah.
holdings here, right? So that's how I got
Perfect.
to there. Yeah, and look, all these ETFs are different. Some of them might be offices, some of them might be warehouses. So you got to take a look at, these are all how many components, so 30 of them in there. So I think there are REITs now that are also data centers, I think, are REITs. They have a bunch of different ones, but traditionally what are REITs are basically dividend yielding instruments, right? They're basically passing the income they make with dividend. They're not really, it's not really a technology company or something. It's more, I look at them as, how much dividends can they generate, and how much can they increase it over time. And that will be an issue, in my opinion, as interest rates go up. They're going to come under pressure, especially if we go to 3.5%. Eventually, they're going to be under pressure. So if there are no follow-up questions, I'll just move on to earnings.
Yeah, you can move on.
Okay. On earnings, let's take a look. Let's take a look at first this earnings moves, and this is tracking earnings from April 1st. So we look at April 1st as that's when we kind of start getting reports in for the first quarter of how companies did. So far, there are 333 companies from April 1st that reported, but I'm going to go to the S&P 500 stocks. So I'm going to filter out SPY. And we had 83 companies that reported in the S&P 500. After reporting earnings, 52% of those stocks were higher on the day, 48% were lower, and on average, they lost 0.3%. So why are they losing on average? So some of them that were lower, the magnitude of the down moves were greater than the magnitude of the up moves, right? So that's why you could have an average that's lower. So if you have one stock that's up 1% and one stock that's down 10%, you have two reporting, but on average, if you bought both of them, same notional amount, it would have been a loser. So this is looking at, the average of the returns. So if we took these 83 same companies and compared how do they usually do after earnings, This is the 3-year average. So 49% of those were higher, 51% lower. But these same 83 companies on average did lose after reporting earnings 0.1%. Right now, they're down 0.3%. So underperforming their 3-year average. And we could take a look, why is that happening? So you could see here, this is quarter by quarter. So you could see here positive returns. We have some negatives, 2 positives, negative, and this is the 3-year average. And if we took a distribution of these returns, so how many of them were up above 0? How many of them were down? So we see 43 up, 40 down out of 83. But if we go here to the wings, 6 stocks dropped by more than 9% so far. Out of the 83 that reported, only 1 was up more than 9%. And if we go to the 12%, so far, we haven't had a stock that was up more than 12% after reporting earnings, but we did have 3 stocks that tanked more than 12% after reporting earnings. So it's those, even though more of them are having a positive reaction, the ones that are having a negative reaction, we're seeing more extreme moves to the downside than the 3-year average. Okay, so that's how to read this report. That's the distribution right here of those returns. Let's take a look at the straddles. So how did the straddles perform? And the straddles are basically you're buying the call, buying the put, and if you're buying both, what you're saying is that the market is underestimating the move, underpricing the move, and the move will be over, right? So if you're buying call, buying a put, the stock has to move up or down by big enough percentage to cover the cost of both the call and the put. Okay. If it's within that range, that straddle will come in. If it's outside that range, the straddle will be more valuable. It's like an over under. So how did the market price the over under moves? So we see that 45% of them, the straddles were profitable. 55% they were not profitable. So basically, 55, the negative means that 55% of them, the move was over. The implied move, the straddle overestimated the move. Okay, the move was not as great. 45%, the move exceeded what the market was expecting the range to be. So the actual move was over. Okay, and here on average, if you did all these 238 companies, so this is not just looking at S&P 500, this is looking at all the liquid options that we found. On average, the return was 3.7%, per earnings. So let's take a look at the S&P 500. So here also on average, we see that so far out of the 80 companies that have what we consider liquid enough options, 44% of those, the straddles are profitable, 56% not profitable, but on average gained 8.7%. So why is the average higher than if there were more negative? Because the ones that were profitable, right, had more extreme, right there, those were more profitable than the ones that were not profitable, right? So we could take a look here. Here's the 3-year average. If we took that same 80 stocks, here the 3-year average. Usually the straddles overestimated the move. So selling the straddles on the 3-year average performed better, 3.3% on average negative. That means they were down on average 3.3%. This quarter, so far, we're seeing on average 8.7% positive. think Netflix probably had something to do with that too. Let me just take a look at the, so you could see here, there are two stocks. This is the distribution of the returns of those straddles. So we could see here that 35 stocks, there the straddles were positive, 45 negative. Straddles that lost more than 75% of their value. Those two of those, okay, that lost more than 75%. 9 of those straddles gained more than 75%. All right. So in other words, if you bought, straddle for $1 the day before, next day it was more than $1.75. Right. This would have been if you bought $1 straddle for $1, next day it was worth less than 25 cents. So that's how to think of it this way. So you could see here 9 versus 2, right? 9 stocks gain more than 75%. 2, that's where we're getting those wings. Above 150%, there are 4 of them, compared with a 3-year average of 1. So you could see 4 times as many, right? Gained over 150%, more than doubled after reporting earnings. Okay. So that's a double is 100%, right? That's double. This is already more than that. So that's how right now we're seeing big moves, some big moves on earnings. Okay. Let's just see what's coming up here. I'm going to take a look at, we talked about this chart a lot last week, but I'm going to skip it for now just to take a look at what's coming up this week. So these are the stocks coming up, the big ones, right? So the Microsoft still going to be reporting tomorrow, Google, Visa to report, Facebook, MasterCard, Apple, Amazon, April 28th. This is coming up. ExxonMobil, Chevron, ABBV, PFE, Pfizer. These are coming, some big ones, notable ones coming up. So that's going to be interesting to hear from them. Some people are saying Apple right now, might be another FANG stock that people are starting to worry about a little bit. Let's just take a look there. 26p, 7.4 price to sales, $2.6 trillion. We'll see what Apple says, but they're expecting to come up this week. So if there are no questions, it seems like I'll just stop right there.
Yeah, we did have, and this is, I'll read it to you, but it's maybe something Ronald can come on tomorrow because I think we need more information. But I'll let you hear it, okay, and then you can give your thoughts. Ronald asked, I had a question about how to hedge long-term put credit spread positions. I would think we need more information, but yeah. Anyways, that was the question.
Yeah, maybe if you come on, explain, maybe show like an example of a position and what you're trying to hedge. Okay, so come on, and with options, there are things that are hedgeable that people use depending on what you're trying, because you could hedge your deltas, right, and trade your gamma. So you can hedge deltas, which are directional risks, maybe your vega. So you have theta. So you have different risks on your positions, and depending on what you're trying to accomplish and what you're trying to hedge. Because if you're hedging away some of the risk, but you're always going to have a different, you're trying to isolate something that you feel like, okay, if I think the implied vol is high, but I don't want to take a directional risk, you could hedge off your directional risk, right? Or you think the that maybe the long-term implied vols are higher, the short-term, and you want to spread out vega. So it depends what you're trying to achieve and which risk are you trying to hedge off. So perfect. You could come, if you come on board, kind of shows the example what you're trying to achieve. I think that will be a good starting point.
All right. So Ronald, I put in the chat, support at MarketChameleon.com. Email us if you want to come on tomorrow, maybe expand on your question so we get an idea, and we'll get you on tomorrow if you want. Everyone else, thanks for attending today's morning show. It was great to see Goat back on, or see Goat's chat back on. He was back on the chat, and he was on last night with Dan Passarelli as well. D, great job, my friend. Thank you.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day, and